Recording. Okay, so welcome Tabang to our second lecture in our accounting lesson. So previously in the first session or lesson that we held, I began to explain to you regarding to aspects pertaining to bank recon. So of course, we didn't touch in detail regarding to the concept, but what we really dealt with a lot was with regards to how they examine you or how they test you on the principle of bank reconciliation in a setup of a test or an examination. And then, of course, you also brought it to my attention that you've got a test, an upcoming test that you're going to be writing, and they are testing you on these concepts, which I'm going to write down on the...
It's actually a term test.
Repeat again?
It's a term test, like
Oh,
the
it's a term
exam.
test, not an exam, right?
Yes.
So you said they're testing you on these two concepts. I think you mentioned something about the fixed asset register, right?
Yes, fixed asset and bank reconciliation
There's bank reconciliation,
and the creditors reconciliation.
as well as the creditors reconciliation. What about the debtors?
Uh,
It's not there.
I'm not sure.
They didn't mention about it.
No.
Okay, so it's only these ones that we have written down, which they stated that they were going to test you on. Hello?
Pardon?
I'm saying it's only these ones which they've stated that they would test you on.
Yes.
Okay. Okay. No, it's not a train smash. That's fine. Okay, so can I do you have some questions? Maybe say from the textbook or exercises which they've given you that perhaps you might want us to look into, or do you want me to explain maybe the theory parts to some of these, especially creditors recon, and then maybe we can get into some questions thereafter?
Yeah, I think that one's better.
Okay. All right, all right, all right. No problem, buddy. That's fine. Just give me a second. I just want to quickly check out one of these books here that I feel might to make use of them. All right, just a sec. Let me begin to explain to you. So bank recon, you said you're okay with it.
With what?
The bank reconciliation.
Well, I can say I am doing better at bank reconciliation than the other one.
Okay, no problem. In the meantime, what I want you to do, I want you to take a picture in your textbook of one of the activities that they've given you on creditors recon and send it to me so that even after I'm done explaining to you the principles around it, you still at least have an idea of what is going on. Is it fine?
Yes.
Because at times you might think you're okay, but you only realize, whoa, it's not the case per se. So I
The
need
bank
to
reconciliation or the creditors?
repeat again.
Bank
Okay,
reconciliation or creditors?
both of them.
Okay.
Yeah, both of them, I think. Both of them would be very, very helpful. There's also a question, exercise or an activity that I have on my side, which we are going to look at, okay? I'm going to share it with you now on WhatsApp. All right, so let's talk about creditors reconciliation, right? I'm going to take you to the notes on the PDF just in a moment, but let's unveil it. Why do organizations perform a creditor's reconciliation? Why do organizations conduct or perform a creditor's reconciliation in the first place, right? Now, in order to answer that question, you need to look at it from this angle. On the one side, you've got a business entity that is carrying out some business activities here. And some of those activities which the business is carrying out would involve participation with what we call creditors. So creditors by definition simply refers to third parties that we as a business would buy goods or services on credit from them. So the relationship that is existing between us and them, it's simply us buying, okay, goods, not only goods, but at times it can be a service on credit from these guys, from creditors. So now what happens is when we as a business entity buy some goods or services on credit from these guys, there will be a recording, there will be documents that will be used in order for the transaction to be kept on record. So from our side as a business, now I'm gonna try and show it on the next screen. So from our side as a business entity, to keep track of what has transpired with our creditors, you would have what we call a creditors journal. A creditors journal. In the creditors journal, that's where we will record all the individual transactions that have to do with us buying the goods on credit from our creditors. Buying goods on credit from where? From the supplier or the creditor in this case. Are we together?
Yes.
So we'll keep some records in our creditors journal. And then at the same time, we also maintain something that is called a creditors ledger. A creditors ledger. Now, in a creditors ledger, this is where you see, all right, account balances. All right, account balances of each creditor that the company is owing. So when I look at a creditors ledger, I'm able to see how much and how many creditors we have as a business, right? Now, from the side of the creditor, since we are buying from them, they will also have some records that they would keep, which they would normally communicate to us as the business entity. And this process happens on a month-by-month basis. So when when the creditor communicates with us, they would send us something that is called a creditor's statement. Are we together? In the creditor's statement, we are able to see the true reflection of what we are owing the creditor. So it gives us a true reflection of what we owe the creditor. So in other words, a true reflection of the credit, all right? Of what credit? Credit of what we have acquired from the creditor on credit. Are we together?
Yeah.
Very important, okay? Is it making sense?
Just a bit.
A bit for now, right? So, okay, let me repeat again. notice the parties involved when you're dealing with the creditors recon. There is a business entity which is buying some goods or services from this party called a creditor. A creditor is basically any party that sells goods or services to the business on credit. That's what a creditor is in simple English. Are we together?
Yes.
Hello? Are you understanding me?
Yes.
Okay. So now this creditor, because they are selling to us on credit, there will be records they will keep on their side. All right. And those records they would keep, they will also send a communication to us as a business to tell us how much we are owing them. All right. Because obviously, from our side as a business, okay, we will record every transaction that we have engaged in with the creditor. What do I mean? Whenever we are buying from the creditor, we have to record the transaction of our purchasing from the creditor. We have to record it somewhere, and that record is kept in what we call a creditor's journal. In the creditor's journal, that's where you've got your purchases, journal, and all that. So this is basically to record for transactions where we are buying goods on credit from the creditor. That's your creditor's journal. And then we totalize all of those transactions because at some point we also pay these guys, okay, for whatever we've bought on credit from them. We will pay them. So there will be some other journals that will be affected as well. In this case, to be more precise, your cash payment journal, there's also the general journal that will be involved, okay? All of these will be affected whenever we are buying and paying the creditor. Then, of course, we have got creditor's ledger. So in the creditor's ledger, we are able to see the different account, or we are able to see the different balances we are owing to creditors by their names. And then there's something called a creditor's list. Are you following?
Yes.
There's something called a creditor's list. A creditor's list would be a list indicating the name of a creditor and the amount that we are owing them. So essentially, when we do a creditor's reconciliation, we want to make sure that what we have on our creditor's ledger against our creditor's list is actually communicating the same thing. I don't know if I'm making sense to you.
Makes sense.
Right. Then, of course, all right, let me put it this way, because I really want to make sure it makes sense. Let me really break it down for you. So as a business, okay, you would have records, like I've mentioned earlier, right? You would have your creditors ledger somewhere here. You would also have some information from your creditors list. But normally the creditors ledger and the creditors list, they will almost have the same balances. So you'd have a creditors list. And then, of course, you would receive a communication from the creditor. And that communication comes in form of what we call a creditor's statement. Are we together, buddy?
Yes.
Right. So you get something called a creditor's statement. And then at the end of the day, what you want to achieve is to say information in the ledger, so we're talking about the balances here, should be equal to the balance according to your creditors list, and the same balance should also be reflected here. Are we together? So
Yes.
these three documents, they should communicate the same thing. But under normal circumstances, it's not the case. Why? Because these first two information, it's coming from within the organization, so they are likely going to align. In other words, they are likely going to have the same information. And when I'm saying the same information, I'm saying about they are likely going to have the same balances, okay, of what we are owing to the creditors. But with creditor statements, you are getting creditor statements coming from different people. So you have creditor A, you would probably have creditor B, creditor C, and maybe what you had recorded about creditor A here is different from what is reflecting on their statement. So you might have a case where, according to your records, you are saying you're owing this person or the creditor 10,000 rands. But according to the creditor, they will be saying to you, no, you're owing us 12,000 rands. Are we together there? So do you see that there's a difference now between what your list, creditor's list is reflecting and what the creditor statement is reflecting? Question is, what is it that causes those differences? That is where now creditors reconciliation comes into the picture. Creditors, that is the purpose of a creditors reconciliation. So it's basically to reconcile the differences between what is reflected from the creditor statement against what we have in our records as a business. So what we can have in our records, it could be information from our creditors list, our creditors ledger. All right. So when we do a comparison of what we have on our records as a business versus the creditor statement that is coming from the creditor, we can be able to identify some deviations. So like in this case, there's a difference of 2,000 rands. Can you see that?
Yes.
Which we have to then account for here when we do the creditors reconciliation statement. Now the question that you should ask yourself is, what is it that causes these differences to happen? What is it that causes the difference between what we have on our records against what the creditor statement from our creditors could be reflecting to us? So the differences happen because of this. Let me show you now. And I'm going to explain that on the next page. So those differences, because that's what we have to account for when we do a creditors reconciliation. So what causes those differences, young men? It's because of omissions.
And errors.
And errors, exactly. You're getting it right. Omissions and errors. What is it that causes errors? Errors, these are just basically human mistakes. Are we together?
Yes. And
So
then the omissions is like overstating or like understating, is it?
Yes, overstating or understating. Are we together?
Yes.
So we want to understand why. Okay, under what circumstances would we have a case where there's an overstatement or an understatement of the creditor's account? Okay, because the error can happen on our side. Maybe we missed something that the creditor had communicated to us, or maybe the creditor on their side, they missed or omitted something on their side. That's why we could possibly have differences like this taking place. So think about it. Maybe this 10,000 rands, which we have on our books, it is simply because we did not record the 2,000 rands of credit that we bought from this creditor A. So maybe we bought other goods worth 2,000 rands during the course of the month, but our creditors clerk forgot to add that 2,000 rands to the balance of this particular creditor A, which we are owing. So obviously, if they omit that balance, guess what's going to happen? You're going to have a case where it would appear in this case, because we recorded lesser than what we were supposed to have recorded. That is what we call.
So I'm just going to add 2,000.
Yeah, exactly. So on your recon here, that's what you would just simply add to that value, right? So in this case, we've got an understatement on our records. Why understatement? Look at this. You recorded only the balance of the creditor to be 10,000, whereas it was actually supposed to be 12,000 rands. Why was it the case? You understated this balance of a creditor because of an omission of 2,000 rands. So obviously, in your creditors recon, you'll be adding that 2,000 rands on the column for creditors, okay? Account or creditors ledger. So far, so good?
Yes. Can I just say something?
Yes, please. Go ahead.
In our books, we only have creditors ledger and creditors reconciliation according to the activities.
All right. So okay. So the creditors ledger and the creditors list, they're almost one in the same. They're similar. What a
And the
creditors
creditor
list?
statement,
Yeah. And the creditor statement, you also have it in your book, right?
no, we only have creditors ledger and creditors reconciliation and just the adjustments or additional information.
The additional information, it will be coming because they compared the creditor's ledger against the creditor statement. So when you see adjustments that they will give as additional information, that those adjustments, it's because of a comparison that they did. Like, okay, take a picture of one activity and I want you to read the required part and maybe the additional information, and you'll see what they are saying. Just any random activity, and then I'll explain to you what is going on.
The problem is we already did them at school,
Okay.
most of them actually.
No, that's not a problem. The point I'm just trying to make to you is that when you see the adjustments which they've done in the book, right? I mean, the adjustments that they'll provide in the questions in your book, what has happened there? The adjustments are coming as a result of comparing creditors' ledger balances against the statements that are coming from the different creditors which the company is owing money.
Okay.
Yeah, that's the point I wanted you to understand. So whatever I'm still teaching you and giving you, it's relevant. Because I wanted you to understand where are those adjustments coming from. Because under normal circumstances, you may be given a creditor's ledger somehow, they will provide it to you, right? And they want you to to do a creditor's reconciliation and then, do some adjustments according to what they've given in the question. But question that should come into your mind, how did they come up with those adjustments? That's the question I'm answering when I'm saying they compared the creditor's ledger against the creditor statement. All right. I see you've sent me something. Let me quickly look into it, and then I would address you real quick here. Right. Now, let's see. Maybe, okay, I'm looking at activity number 3. In activity number 3, okay, I want to look at the required part first. I'm trying to understand what is going on here. Oh, the required part, 3.1, ne?
It's actually 2.
Okay, it's not as clear because I had wanted to.
Okay, let me take.
Just read.
Let me take it again.
Yeah, so that I can see them in a much clearer way. Because I wanted you to understand what is happening there. Because sometimes you might do an activity in class, but without understanding why they are doing what they are doing and how they are doing what they are doing. You see?
Yes.
So I want to make sure that you understand.
Yeah, I believe it should be on the platinum.
Right. So if you look at
I see
okay. Have you resend it?
Yeah, I'm still doing it.
The picture. Okay, no problem. I'll wait for you.
But only optimum class.
Yes, you took it perfectly now. But I wanted to see it. Okay, let me look at activity 2. So I want you to understand what's going on there. All right. You see when they say statement of account on activity 2, I want you to look at, okay, let's start by looking at the required part, and then let's look at the, what you call it, at the additional information. So I'm going to try to also display the same information on your screen so that you you'll be able to follow what I'm doing. Right? Can you see this screen?
Yes.
Now, let's look at this. So in activity 2, they say the debtors received a statement of account from where? From creditor, Kumalo supplier. So do you see that there's a statement of account? That statement of account is the same thing as the creditor's statement that I was talking about.
Yes.
So I'm taking you back to the whiteboard so you understand what I'm saying. So this thing that I was explaining to you here, when I was saying creditor statement, is the same thing as statement of account that is given in your book. So it's just an interchange of words, but they are simply talking about one thing, okay?
How?
Statement of account.
Okay.
Yeah, because I want you to understand what is going on there. So statement of account is the same thing as what? A creditor's
Creditor statement.
statement. Yeah, same thing. Same thing. So what happened in that activity? You received this statement from who? From a supplier, right? But already before you received this statement from the supplier, you as a business, you already had some records that you were keeping through a creditor's ledger. Now let's go to that activity so you can see this. All right, so they are saying debtors, right? So debtors is the business. Are we together? Now, what happened?
Yes.
Debtors received a statement of account from creditor, Kumalo suppliers. So the business is debtors, the creditor involved is Kumalo suppliers. So when I go to the information given here in the context of activity 2, I'm expecting to see records from the business itself. And also I'm expecting to see a statement of account that is coming from Kumalo suppliers, which is in this case the creditor. I'm expecting to see that information over here. Now, I want you to understand something. A creditor's ledger of debtors. So meaning to say debtors is the one that created these records, this information that we see in the ledger for
Meaning,
Kumalo suppliers.
created the
Repeat again.
so yes, we as like the debtors is us who created the creditor's ledger.
Absolutely. Absolutely. So that is us right there. You're following,
Okay.
right? So
Yes.
that's us that created this. So notice here, previously, from the previous month of May, we had a balance already that was existing, which is now an opening balance in our records. Hence, they said account balance brought down 18,710. So that 18,710, it's simply showing you that this is a balance brought down from the previous month. Meaning to say we are already owing this creditor from the previous month. However, there's something that transpired during the course of the month of July. If I look on the 5th of July, we received an invoice, number 154, which we captured in our creditors journal. All right, what is happening there? And it's credited 3915. Why is it being credited? Simply to indicate that we bought goods on credit from this individual, from this organization, right? And notice what happened to your balance from 18,710. Because you are buying, it increases your balance from 18,710 to 22,625. Is it making sense?
Yes.
So all of this, I'm trying to help you to understand that this is the business recording these transactions. Now, when the business have already compiled this, they would then need to look at the creditor's account from this creditor so that they will check to see what they've recorded in their books is matching against what the creditor has recorded on their books. So when you do the comparison now, when you compare the records here and the records here, that's where omissions can be identified. That's where errors can be identified. Does it make sense, buddy?
Yes.
Right. So now let's look at the required section 2.1. Reconcile the account of Kumalo suppliers in the creditors ledger of DB stores with the statement received. Show negative amounts in brackets. So question is, where do you start? Do you see that?
With
Where do you?
the ledger.
So you started the ledger. So what information did you have according to your ledger? You have this balance, 19,353, right?
Yes.
That's what you have. So you'd have to use that information there, and then you start checking to see if there's anything that has to be added to this value or that has to be subtracted from that value based on what you are picking between this statement and what you have on your records. Right? But because you've already done that activity, I don't think I have to re-explain. Do you have questions on it, or should I retake you through the whole thing again?
Just the adjustments, I get confused on some parts.
Right. Oh, yes. Let's go through the adjustments. I'm going to open the adjustment part. I'm going to open the adjustments part. Just a second. Let me open the adjustments. I'm not sure if these are the ones. Okay, I found them now. Okay, I'm opening them. There we go.
It is Roman 4.
All right, let's go through each one of them so that, you know, we have a complete assessment. So look at invoice number 154. It was recorded incorrectly where?
And the statement, meaning we did not record the right amount on the creditors.
Does that affect your creditors ledger?
No.
It doesn't, right?
Yes.
But it affects what now?
The statement, the creditor statement.
Yeah, it affects the creditor statement, you see now. So in this case, it does not affect your creditors ledger, so you skip it because we are trying to look for information that affects our creditors ledger. So the mistake or the error, it happened on the creditor's statement. When the error is on the creditor's statement, other than the ledger, it does not affect your creditor's ledger, okay? Because it means the information in the ledger is correct. So with this one, we skip it. Because remember what is happening in 2.1. You are reconciling the account of Kumalo in the creditor's ledger and whatever. So when you do the creditor's reconciliation, you would have two columns. Are we together, young men?
Yes.
There will be two columns. So I want to explain to you why those two columns are there. All right. So one column is showing you a creditor's ledger column, and then the other column is showing you the creditor's reconciliation. So you see that mistake that happened on the creditor statement. Where do you think that correction is going to go to? It's going to go to the creditor's reconciliation statement. Does it make sense, young man?
Yeah, no.
All right. Remember, the mistake did not happen on the bank, on the creditor statement. Right?
Are we talking about Roman 2?
Yeah. Yeah.
Oh.
So what I'm dealing with, okay, so that you understand where we are. The creditor's reconciliation statement, look, okay, let's connect on video B now, and then I'll explain those things to you just now. So use the same link, and then we'll proceed from there. Because it's already saying we're left with 1 minute.